What will it actually take to kill this bull market? Hello and welcome to today's Daily Blitz. Now, recently I was asked by a colleague to come up with some arguments for why or what might finally take down this bull market that we've had ever since the financial crisis. What will it really take to finally see a sustained depreciation in stock prices around the world? Now, this was done mostly as a thought exercise, as I've recently been saying, as I'm sure you know if you watch the Daily Blitz, that we'll have a melt-up this year. So this was an opportunity for me to take the other side and really argue for the opposite. So to start with, I'd like to show you a chart that I think an awful lot of people overlook, or they simply don't even know exists. So what you can see on the screen there is the MSCI World Index, so it's the global stock market, but subtracting the US stocks from it. So it's everywhere except the US. And as you can see, it's actually yet to reclaim its January 2018 levels, which was interestingly at the same time that Bitcoin peaked. And I don't really think this is much of a coincidence. So everybody is transfixed by US stock performance and not that of the rest of the world. But US stock performance, when you think about it, has only been sustained with the US government blowing cash in a way that only the reserve currency issuer can. And even that has gotten to such a degree that the Federal Reserve has now had to expand its balance sheet and actually start effectively lending money to the government directly by buying treasury bills the very day that they're issued. Now, it's still not doing it completely directly, so there's still a primary dealer bank that lends money to the government first before the Fed then lends money to them. The stock market is now being increased by the inflation of money itself. So if you look at this chart, this is the Dow Gold ratio, and it effectively illustrates how much gold your stock market portfolio can actually buy you. And interestingly, that's actually started to go down. So much fiat money is being printed that the stock market is rising certainly, but it's not rising in real terms, not rising in gold terms. An investor is being rewarded nominally for an inflation in price, but not in terms of purchasing power. Now, historically, when the Dow Gold ratio has begun to go down, this has been actually a very bad time to hold on to your stocks rather than simply hold on to gold. So if you see this chart on your screen there, that shows all of the previous peaks of the Dow Gold ratio. And as you can see on the far right, we've just started to go down there. But if you look at, say, 1929 and the Nixon shock, those were all bad times to be owning stocks rather than gold. And then if you zoom out slightly, so away from the US again, you see that global economic expansion has been powered by China, and China is running out of gas. So the Chinese influence on the global economy has been to export low inflation around the world, low inflation being very good for stock prices in general, and it's also been very good for profitability for these big multinational corporations. But the Chinese economy has only been able to expand and actually sort of export all of this low inflation using huge amounts of debt, and it is starting to become clear that the capacity for that debt is starting to run out. So if you look at this chart, this is the Chinese credit impulse, and that's illustrated in light blue against manufacturing, which is in dark blue. Now, the credit impulse reflects the desire and the capacity for debt within that economy. So as it's a debt-driven economy, very strongly driven by debt, you can see that the capacity for it is trending down. You'll note there's ever lower peaks, and they are highly correlated with manufacturing. So if you're relying on China for economic growth, you're relying on China for GDP growth, it appears the capacity to create that is going down. And so under the weight of this great pile of debt, if you look at this next chart, you'll see that actual real GDP in China, if you believe their figures, so that's GDP adjusted for inflation, has actually halved over the last decade. So if China has no more capacity for growth, where will economic growth actually come from? Now, that question is, I think, a video for another time. It is possible it could come from somewhere like Africa, but without it, and without a sudden replacement, it's going to be pretty hard to justify further economic growth for the entire world, unless China suddenly manages to pull some kind of magic trick out of the hat. So without a replacement, China's disinflatory force, which has been very good for the stock market, is effectively removed, which invites the idea that inflation is going to return. When inflation is over 4%, historically, that has been very bad for the US stock market, which is, as we've already dwelt on, is the only part of the world which seems to actually be going up. So with the global engine of economic growth, which has bolstered this bull market so far, starting to fail, if you're starting to see China effectively pushing on a string and starting to feel the law of diminishing returns, one has to wonder just how much juice the global economy can then supply to the stock market. But those are just a few of my thoughts on what might finally kill this economic expansion and also kill the stock market. Hope you find something of value in there. But that sums up today's Daily Blitz. I hope you enjoyed it. Be sure to subscribe and click the notification bell below, and we'll see you in the next one.